Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in, Joe Caccera with Real Estate Radio Live. Thank you for those that are following us on Facebook with the live feed. We appreciate that very much. We continue to grow the audience in all different ways, as many different ways as we can, and certainly the social media and Facebook is one of them. However, this is a podcast, so we'd love to have you download the podcast if you haven't done so already. Just go to iTunes, type in Real Estate Radio Live. You go to Google+, Stitcher, any of those places. Also, you can go to our website, reradiolive.com. That's reradiolive.com. You could download the podcast there and find out more information about our podcast. For those that have been following us, hopefully for quite some time, we've almost going on 8 years now, live radio and podcast. We continue to do more and more of the podcast because it's really the best vehicle for people these days. The fact that you can listen to it at your convenience when it's good for you obviously is very valuable to most people. We try to stay on a schedule to accommodate the social media and the live feed on Facebook. So Mondays, we try to stick to right around 11 o'clock Pacific Daylight Time, and then Tuesday, Wednesday, Thursdays, we're in it doing the show right about 3 o'clock Pacific Standard Time. If you could follow us, that's great. Most of you know the focus is education and information. So even though majority of our topics are in and around real estate, we also try to continue to educate people on anything about finances, taxes, how you could better manage your money. That all equates to real estate as well. So every Monday we've started, Mark, it's been, 3 or 4 weeks now, maybe?
Yes.
We've started our series. We're going to have a continued, ongoing series on Mondays right around 11 o'clock, as long as people's schedules don't change. And that's Accessing Home Wealth Without Debt. Again, the ongoing series is Accessing Home Wealth Without Debt. We're going to get into the details of this program. It's exciting, and there's a lot of opportunities really in an economy that's changing in many different ways. Number one, we're going to talk over and over again and educate people because it is an educational process. Anytime you have a program that's new, people are trying to get used to it. Plus, we're so used to the traditional mortgage and the debt and the liabilities that we have been sold onto with the banks for years. A lot of things are changing, just like technology is changing, and a lot of programs are changing out there too, and there's a lot of investments going into programs like this and others that give you, the homeowner and the consumer, more options. So let's dive in, Mark, talk about the program. Before we do that, maybe you could just give us kind of a quick background overview yourself, and then Bear Stone, when you guys get started, and we could jump into our talking points.
Great. Thanks, Joe.
You're welcome.
We started Bear Stone about 4 years ago when we recognized that there was a need for homeowners to access the home wealth that they had built up. A lot of homeowners, especially in California, have seen their home wealth grow exponentially. And they have $1 million, $1.5 million dollars of equity in the home, but don't want to take out a loan, or in some cases can't qualify for a loan. We saw this as a huge opportunity to design a product that would allow the homeowners to access their home wealth without taking out a loan or incurring any additional debt. There are no monthly payments, and best of all, it's not a reverse mortgage, which can be negatively amortizing in your home. This allows the homeowner to access up to 20% of their home wealth in exchange for sharing in the future, not their current equity, but the future home price movement, meaning if the house goes up in value, you share some of that with the investor, and if the house goes down in value, the investor will share in some of that decrease with a homeowner as well. So it's a great opportunity for homeowners to access all of that wealth in their home and to manage it more effectively.
Very good. Yeah, that's exactly what it is. And we're going to give you some examples. I mean, Mark, for, up until now, or I shouldn't say up until now, within a couple of years ago anyway, most people's options were the traditional mortgage, take a loan out on your property, a first loan. Then many people resorted to the home equity lines. And I have to say that The home equity lines were really, really popular over the last decade. And let me tell you the reason why. One, there was home equity. People grew equity. They grew the percentage of equity. But the other big component that is changing right now that I can't stress enough, one of the reasons why home equity lines were so popular over the last decade is because interest rates were at historic lows. Think about that. Remember that. Keep this in mind. I could tell you at least 3 or 4 calls or emails I get every week now. I just got one today before our show, Mark. One of my clients emailed me a statement saying, Joe, I noticed my rate just keeps going up. And so remember when the Fed rate was, almost zero for years, you had these low payments. The payments didn't change. But what's happening right now on these home equity lines, for people that have balances, you're seeing them go up every single month. And then here's the other big equation that happens is most of people don't know or they forget that they're 10-year programs. So at the end of 10 years, most of these home equity lines, what they do is they call it recast. So they recast to a 20-year. Now what happens is the interest-only payment goes away, and they recast to a 20-year amortized principal and interest loan. So it's a payment shock.
It is, and we get those calls as well with people where the home equity loan is coming due, and then it's going to recast.
Right.
And the payments we've seen go from $400 a month to $1,600 a month, and the homeowner can't afford that, and they can't refinance out of it into a mortgage, the whole mortgage.
Right.
And so as a result, we can help them with this product, and they can pay off that home equity loan without any payments. It's very, very difficult for a homeowner when that home equity loan recasts into sometimes 15-year or 20-year. They can't understand why the payment has gone up so exponentially.
Right.
It's because now you're paying off that principal balance over a short period of time, along with an increase in interest. With our product, they have the ability to pay that off and not worry about monthly payments.
Right. And again, the reason why we're going to continue to educate consumers on this product right now is I'm a big believer in timing. The timing is right now for the things we talked about. Rates are going up. Home equity line programs aren't as popular as they used to be. But remember, the other component we have here is because we had interest rates so low for so many years, there's a lot of people, and rightfully so, it's great, they've benefited by getting 15-year fix in the 2% range, in some cases 30-year fix in the mid to low 3% range if you were fortunate enough to hit that number right. So we have, Mark, is a lot of people with, a balance on their first, and they don't want to touch that. And that's another reason why this program is really a great option right now, is because you could leave that alone in many cases and take care of outstanding debt.
Yes, one of the big benefits of our program is that you can leave your existing low-rate fixed or variable rate mortgage in place and access cash through our program without having to pay that off.
Right.
So if you have a $200,000, $300,000, or $400,000 mortgage at a very low interest rate, you don't want to refinance that with a cash out because it's going to increase the overall payment over that entire principal. With our payment, it's a supplement on top of that.
Right. Absolutely. So let's dive into some details about the program. Why don't you explain a little bit how it works, and then we'll go over all the different ways that you're seeing people use it, I'm seeing people use it, and then some of the ideas we could share with people as well.
Sure. The overall program is homeowners generally have to have probably 40 to 50% home equity in the home. If they have at least 50% equity, there are programs we can qualify them no matter what their credit score is and no matter what their DTI is, as long as we can show that the money that they're going to get will help them supplement their monthly payments. So it's a great way to say, homeowners, you have a lot of equity, you can use that equity to solve your problems. We have 10-year product, 20-year product, 30-year product, and we can customize the program to meet the homeowner's need.
Right.
They can get up to 20% of the home value, meaning if you have $1 million home, you can get up to $200,000. You don't have to access $200,000. If you want 10%, you can take $100,000.
Okay.
In exchange, they will agree to share in a percentage, and the percentages vary of the appreciation. and if the house depreciates, they will share in a percentage of the depreciation of the home, which is, basically the investor is a partner with you, and everybody's goals are aligned.
Right.
Everyone would love to see the house go up in value, but we don't know.
Right.
We've seen a lot of appreciation over the last 5 to 10 years. We don't know what the next 5 to 10 years will look like. So it's a great way for homeowners to access that wealth now, especially after the large increase in home values.
The one important part I want to make sure you emphasize here is that the equity, or I should say what you share, the value you share, is a future price range, right? For instance, if you have a home that's worth $1 million right now, Mark, that has nothing to do with any previous equity or anything that you own in the home. Maybe share that a little bit. Explain that.
Well, homeowners have earned all of their equity.
Right.
They keep that. We're not accessing or taking any of that equity. Basically, the investor's giving the homeowner a payment, and what they get in exchange is the right to participate in future home price movement. That means that your house at $1 million, that value's locked in. All of your equity that you have today, you keep.
Right.
What happens in the future is what the investor is investing in. The big takeaway here is this is an investment by the investor. It's not a loan.
Right.
So homeowners have only had one tool to manage their home wealth, and that is loans, more debt on the property.
Right.
And as we saw in the Great Recession, all of that debt can come back to haunt you. If you pile on too much debt in a property that decreases in value, you can get yourself upside down. In this scenario, it's all about the future. If the property goes down, the amount you owe back to the investor can be less than the money you originally received. So if you get $100,000 and your property goes down 25%, or 50% like it did in the Great Recession, you're going to owe less money back to the investor than you receive. So your house is a variable asset. It can go up or down. This product is a variable product as well. The amount you owe will go up or go down in lockstep with the price movement of the home.
Very good. All right, here's what we're going to do. We're going to take a quick break for the podcast. So for those that are following us on Facebook, just stick with us. We're going to take a quick 1-minute break, and we'll be back with you in just a minute. Thanks.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
Getting ready to buy or sell a home in 30, 60, or 90 days? Check out BundleSelect.com to find out how you could save 20% or more on your entire transaction, real estate, lending, and title. With BundleSelect.com, technology and a personal concierge are at your service to save you time and money. BundleSelect's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling real estate, lending, and title services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. I'm here to tell you BundleSelect.com is the best way to save money on real estate. By bundling services, you could save tens of thousands of dollars. This savings model could save you money on your move, lower your interest rate, or cover your closing costs. Visit BundleSelect.com. That's BundleSelect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker License Number 004666902.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live. Again, today we're visited every Monday. We're doing an ongoing series of accessing home wealth without debt with the gentleman from Barrowstone. Today we have Mark Rogers with us. Steve Hodovec as well is not with us today, but we rotate and we try to do the show every Monday at 11 o'clock. The focus, again, is to bring awareness to this program that's really exciting in a marketplace that provides consumers an opportunity to access home wealth without that debt, which is really, really important. Up until now, we talked about in the first segment a little bit about the program, how it works. But, your other options, we talked about home equity lines. Some people would say, well, what about the reverse mortgage? And reverse mortgage, again, is a great tool, or I should say a great program for the right person. And the reason why we're showcasing this program is because this just gives you another option. And most of us are all, Mark, big fans of options, right? I mean, it just goes without saying, if we walk into a store or if we're shopping or we're buying a car, I don't care what we do, we all like options, because then once we review our options and do our due diligence, we find out what's best for us.
That's correct. As you said, a reverse mortgage is a great product, so are home equity lines.
Right.
This is an alternative,
right,
and just gives a homeowner another option. And, depending on the situation, this might be a better product, or a reverse mortgage might be better, or a home equity loan might be better. When we look at ourselves as home wealth specialists, we sit down with the homeowner, or we speak with the homeowner on the phone to understand their whole financial picture. And in doing so, we look at what is the best option for them. And if our product is the best option, that's great. If it's not, we'll tell the homeowner. We won't try and put them in a product that doesn't suit their needs, because ultimately our goal is to help educate the homeowners on home wealth. And that's really where we started out. Is we come from the financial world as financial analysts, and so we look at ourselves now as home wealth specialists, looking at how homeowners can best manage
right.
this. In most cases, their largest financial asset, which is their
right.
home. And up until now, there haven't been tools that are available for homeowners to manage that home wealth. And that's what we present the homeowners with, is tools to manage that home wealth.
Yeah, very well said. So we're going to start talking about a lot of the different reasons people are using them, some of the things people are having a lot of success with, and we're going to get into the details of that. Remember, the other piece there that I want to bring up is, if you could imagine this, what are your options to really, leverage, not leverage is the right word maybe, but I guess to liquidate, I would say, Mark, is the other thing. Here's what I would say. Before you automatically think about liquidating assets from a 401k, a retirement, a savings, stocks, a lot of people will leverage credit cards. Before you automatically think that that is your only option, this is, again, one of the programs you should really think about. Mark said that they've had a lot of success. For instance, let's talk about some of the examples, Mark. You gave many examples of people with credit card debt. They get into credit card debt. One of the things that we were talking about today is they have a lot of these credit cards where they have the teaser program for a year, right? 0% interest for the first year. But then if you get your magnifying glass out and look, what those interest rates could be 20+% going forward.
Yeah, we just had a client that had, over the course of years, run up credit card debt. He had about 5 or 6 credit cards, close to $50,000 in credit card debt. And when we analyzed all the debt, the average rate he was paying was 21.5% interest. And he was struggling to make those monthly payments of just the interest.
Just the interest, right.
And that was all he was paying, and that debt was never going away. And because he was carrying that high debt load, his credit score kept going lower.
Right.
And so he was faced now with, credit card debt and a low credit score, which, took out some of the other options, which was either a reverse mortgage or a home equity loan or a cash-out refund.
Right.
Those options weren't available. Our solution was the best he could hope for, which was he was able to get enough money to pay off all of his credit card debt, and since it's not a loan, it doesn't show up on your credit report. We have a 3-year plan in place for him to really save enough money so that he can pay this off in 3 to 4 years. And as I explained to you today, we just had a client last week that successfully did that. We did the program about 3.5 years ago, and he was diligent. He wanted to put his financial well-being back in order. He did our product, paid off all his credit card debt, got some additional cash to do some things, home improvements, and came up with a plan for him to save that money. And ultimately, he just paid this off last week. So his credit score is now well above norms. I think it's in the 700s. And he's debt-free outside of his first mortgage.
Yeah. So that's one of the options. We're going to talk about several different things right now. One is obviously consolidating debt, getting rid of debt. Remember, using this plan, there's no payments. As Mark was talking about, the reality is that many people go through this. It's not a right or wrong. It's really just how do you best fit the solution with the problem. And when you're talking about 20, 21, 25% interest, it's really difficult for most people that get, an average to even above average income to ever pay that off. And that's the sad part. Most people don't understand that. If you look at the fine tune at the credit cards, it should be almost illegal the way it's marketed. And, you could see some of them, and I think most people ignore them because you don't want to see them, but they'll disclose at the bottom, like, if you take this to the limit or, take all the time you can, it's amazing the amount of money you're going to pay. So the message here is, if you have debt, it's a great option. It's a great resource to use. Also, Mark, some of the other things we talked about, paying off an equity line, maybe in some cases, too, we talk about every week, which I think is worthy of noting here in the Silicon Valley. There's a lot of entrepreneurs. As a matter of fact, in the year 2030, I read that nearly 50% of people, consumers, will have either some kind of or be self-employed. So the likelihood of more and more people starting their own business, doing entrepreneurships, maybe starting a little hobby that turns into a business is very likely. And this is another great program for that, right?
Sure. We've had several people that are either starting a new business or expanding their existing business. One of the problems that you have with starting a new business is you don't have any track record. Banks aren't willing to loan to you. So you don't have very many options in getting that business financed on that business alone. So what's happened is some homeowners have taken out second mortgages or third mortgages where you have a monthly payment and that debt is tied to your home. And when you have debt tied to basically the financing of your own business, the issue is if that business does not succeed, and the small percentage of businesses that don't make it, or at least people think that they don't make it, the reality is a lot of businesses don't make it. You're saddled with that monthly payment even after your business doesn't make it and you're not making money.
Right.
The risk of default is too great to put your home in jeopardy. You don't want to put the home in jeopardy as well as your business. So this program allows you to get the cash to jumpstart that business. And in the unlikely event that the business doesn't make it, you don't have any monthly payments.
Right.
As long as you're in the home, it doesn't come due. So it doesn't change your lifestyle and it doesn't change your payment. So it's a great option for people looking to start a new business or expand a new business. We had a gentleman who has a construction business, and he needed to buy new trucks and new equipment because he's bringing on more people because his business is booming. Well, our product, to get the cash needed to buy 2 trucks, he hired 3 more people and expanded his business, and he's doing really well. And this was a great use of his home wealth to help his business and financial situation.
Very good. So that's another great idea. Again, paying off an equity line, using it to start a business. As Mark mentioned, a lot of us are familiar with that. A lot of banks won't lend if it's new. The other thing is you're not going to get venture capital or angel money and those types of things unless someone either knows you. Typically, you're going to raise money with family and friends. So this is another great opportunity for that. The other piece is maybe you're a grandparent and you hear this all the time. I could tell you I do residential financing. Most people that watch the show, or I should say listen to the show, know that. That's my primary business is residential financing. I could tell you in the last couple of years we tracked this. Nearly 30% of the transactions that I'm doing now, Mark, have some kind of gift funds tied to it. So what does that mean, gift funds? Here's what's happening. It's going to happen more and more. You're going to have grandparents, great-grandparents, parents, You're going to have family members gifting money to help people buy homes. It's just going to happen more and more. It just is, because you have a lot of wealth tied up, and a lot of people in the older generations that are more than happy to help their grandchildren and children and people, the family, buy homes. So this is another opportunity maybe to use the money to help, a child, a grandchild, or even to that extent pay for college debt. Or maybe someone wants college, and this is one of the reasons. I want to remind everybody, this is accessing wealth without debt. This is something you really that I hope resonates, and that's why we'll continue using this title, ladies and gentlemen, is because it's really important when you access this wealth and this capital. Remember, there's no monthly debt associated. You're not making a payment like you would a credit card, a mortgage, a student loan, all these different things. And so it's a very valuable product that way, isn't it?
It is. And grandparents, we've seen this more and more now, want to help their grandkids. Yeah. And we've seen them access their wealth with our product for two reasons. Number one, we had a number of clients that have used it to fund 529 plans.
Okay.
So we had a couple that had 4 grandkids. They used our product, and they funded 4 529 plans. And based on that funding, each one of them, based on the financial analysis, would have their college education fully funded. So it's a great way to fund your grandkids' college education without having any financial impact. Mm-hmm. There's no monthly payments to the grandparents. They don't have any debt. Contrary, if they have older grandkids that are looking to buy houses, it's very difficult for a lot of the millennials now to come up with that down payment. They can afford the monthly payment for the house, but getting that down payment is difficult. Why not give them a part of what they're going to get when you pass away without having any financial impact? There's no monthly payments. You're not putting yourself in any difficult financial situation by accessing that and helping them. In a lot of cases, it allows the grandchildren to stay in the area. So what bigger benefit to a grandparent than having their grandchildren buy a house in the area that they are located?
One of the other things that I really love about this program, Mark, is it allows people a better chance or more of an opportunity to stay in their home. We don't talk about that enough. We talk about all these other ways, which is great. But one of the things that I want to kind of finish up the show with and talk about is really understand that, you have a person that lives in their home for 20, 30, 40, 50 years. It's a very emotional deal to try to either take them out, put them in a care center, a senior assisted living. I mean, those could be the best things for them. But let me tell you, there's a percentage of people that relocate their parents and grandparents out of their own home. They've been there for decades and decades. The reason why is because they can't afford it. Because they can't afford those payments, and they have to sell the home, use that money in some cases to pay for senior care or to assisted living programs. And I don't know if most of you had run those numbers, but those are expensive in the Bay Area. So here's another thought. If you're listening to this podcast and you have a parent, a grandparent, someone that is struggling to stay in their home because they don't have monthly pension and they don't have millions of dollars in retirement to access money, but they have their home. This program, Mark, they could access money, and it would help them in some cases stay in their home.
Absolutely.
Right?
The alternative to selling the home, both emotionally and financially, a lot of people don't understand the financial implications of selling their home. If you have a $2 million home and, say they purchased it for $100,000 or $200,000, that's a $1.8 million gain. Even after the $500,000 exclusion, that's $1.3 million of gain. The tax implications can be 50% or higher. That's $650,000 or greater that you'd be paying in taxes just to access some wealth. With our program, you don't need to sell the house. The grandparents can stay in the house for as long as they want and access this to supplement their retirement. It's a great way to keep them in the house, keep them happy, and not worry that they don't have enough money.
Right. Very good. So there's all kinds of different reasons you could use this. What we want to try to do and what we'll continue to do is educate you, the consumer, But if you want to know more information about this, there's a couple different ways you could do it. You could go to bundleselect.com, just simply fill out some basic information in the contact form, or you could contact Mark. What's the best place, Mark? Phone number, and then obviously some information on the website they can go to as well.
Sure. You can go to Barastone, BARASTONE.com, and fill out the information there. Or if you want to contact us directly, you can do so at 650-802-0800, and someone will be happy to chat with you.
Very good. Again, this is Joe Kuchera with Real Estate Radio Live, sitting alongside Mark Rogers. Mark, good show today. Good to have you back.
Thanks, Joe.
We'll be back every Monday. Remember, put it on your calendar, 11 o'clock Pacific Standard Time for those that don't want to follow us live on the Facebook feed. But again, more importantly, be sure to download the podcast. That way you can listen to the show anytime at your convenience. You could do that by going to RERL-1578-Accessing. Thanks again for tuning in today. Have a great afternoon. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.